Tax season is stressful for any business owner, but if you're a licensed cannabis operator, you're navigating a whole other level of complexity, one where the wrong decision can mean an effective tax rate of 70% or higher. I'm Jay Rosenthal with Cultivated, obviously, and this is Banker on Call, produced in partnership with Shield Compliance. In this episode, Shield Compliance President and CEO Tony Rapanich sits down with Jill Scher, Managing Director of Tax and Business Services at CBiz, to break down exactly what cannabis operators need to know right now. They're going to cover three main strategies for managing your 280E's exposure, why your entity's structure could be worth millions on future exit, and why states like New York have created real tax credit opportunities that most operators aren't taking advantage of. If you're filing or extending your 2025 tax returns in the next few weeks, this conversation is worth your full attention. Now, let's get to it.
Jay, thank you so much. Jill, really happy to have you here with us today. You know, it's the tax time. I'm sure you're fully entrenched in that right now. And I thought it'd be a great opportunity to chat with you about some of the things that are happening on the tax side. Obviously, as bankers, we're always super interested to understand how taxes are impacting the licensed operators that we bank. You advise a number of licensed operators in this space. And so as you look at the potential for 280E relief, and really we have a lot of uncertainty around timing, how are you sort of looking at modeling sort of conservative and upside scenarios? And how does that impact the decisions you're making right now about 2025 taxes that you're putting together?
Sure. Thanks, Tony, and thank you for having me here today. And yes, we are in the heart of busy season. The tax returns are due very soon, or extensions for the 25 tax year, and there's a lot of decisions to be made. Even as we go along in the days, it's imperative to make these decisions, especially for the companies that are newly operating in 2025. There's a lot of decisions to be made. So with what's going on with 280E and the potential for rescheduling or descheduling and all the discussion around that, we have to always remember when we're doing a tax return that the laws that are applicable at the moment in time that you're reporting is what applies to the tax return. So right now, 280E exists, meaning that companies that operate in the cannabis industry are considered to be a Schedule I substance. And that means that the only thing that's deductible is cost of goods sold. But with all of the talk and discussion about rescheduling or descheduling, we have to, really make decisions and prepare clients for anything that could happen. That means that when we're filing a tax return, we make sure that we have documentation in place to take as many deductions as possible under 280E as it applies right now, which means that you allocate as much cost as possible to inventory so you can deduct it. And when you do that, the record keeping has to be meticulous because you have to document how you're getting to those costs. That documentation that's required, even if 280E remains, will help companies to make a switch if there is rescheduling or descheduling, because they'll have the documentation in order, depending on if they do change the law, when the law is applicable. Most of the times, if they do change law, it's only on a future base, a prospective basis. You can apply it retroactively. So we discuss what's going on in the industry with our clients. We discuss some decisions that have to be made, especially for new companies. We discuss positions you want to take and how the documentation works for deducting as much cost as possible. And we really have to go through it in this industry more than any other industry to help these companies to navigate around these very complex rules.
Jill, I've seen and reporting and talked to operators who have sort of almost run two sets of tax books, one for with 280E and one without, and so that they might accrue for that 280E tax penalty, we'll call it, but remit taxes based on a normalized basis. Are you recommending that to your clients, or you just said something I think is pretty important, which is the law that's in place right now is 280E, and so it would seem that it would make sense to remit taxes based on that part of the code being enforced.
Yeah, so Tony, there's a very complicated decisions to be made around what you're discussing right now. So you can either take the strategy and apply 280E to the letter of the law and only deduct cost of goods sold, or you can take the approach that we're very comfortable with, where you allocate as much cost to cost of goods sold as possible when you do your inventory capitalization under a code section called 471, meaning that any expenses for a dispensary or a cultivator or a processor, you would allocate whatever costs are for inventory to inventory. Like if you're a dispensary and you have the square footage of the dispensary and some of that dispensary is dedicated to the storage of inventory, you would deduct part of the rent, part of the utilities for the transportation of inventory and the acquisition. For the employees that maintain that inventory, you deduct it and you allocate as much cost to the inventory. So that's what we do. The other extreme, which is what we also accept, is to get a tax opinion. A tax opinion is rendered by and there's only several law firms that we have vetted that we are comfortable with. It's not to say that we wouldn't use other law firms, but we will take the position that 280E does not apply for a company if they have a properly formed tax opinion, which is done by a law firm. Depending on the law firm, they run about, and the size of the dispensary, it runs about $25,000 to do. We don't do it. We have a law firm do it. And basically, they take the position of why 280E would not apply to this company so that it's on a reasonable basis. With that, we have to do a calculation as if 280E applied and 280E doesn't apply. We file the return as if 280E does not apply, meaning that you deduct everything as if they were selling signs or widgets
Groceries,
or groceries. And then you have to fill out a tax form called the uncertain tax position and actually disclose to the IRS that I am taking this position. And these are the reasons I'm taking this position. And that does a couple of things for the client. One, they pay tax on an effective tax rate where every other industry does. If you're a corporation, it's 21%. If you're a partnership or an S corp, you would pay it based on the individual owner, their allocation. And that's your effective tax rate, as opposed to a cannabis company that applies to 280E that has an effective tax rate up to 70%. So it saves you money. You get to keep that money. In the event the IRS comes in and says, we don't believe in that position, and we are now assessing you tax, and we're assessing you interest and penalty, it gives you a reasonable basis to avoid penalty application if the IRS comes in. And sometimes companies take this position because they're very, gung-ho that they feel that 280E will go away, and they feel that it will go away on a retroactive basis, or they have a good argument for that. Some companies simply do it because they don't have the cash to pay taxes, and they're using this to fund their operations, and that's okay too. And they're also taking the gamble, but it has to be done responsibly, and it has to be meticulous in the way that the returns are prepared and the record keeping is done. We're happy to do that under the right circumstances for companies.
Super interesting. So let me see if I've got this right. So there's kind of three paths you could take, which is just the strict only cost of goods approach, which is super expensive for the licensed operator. There's also sort of the conservative aggressive approach, we'll call it, which is you really try to look for all the opportunities to classify things as cost of goods sold, like you said, allocating rent expense to the storage of inventory so that a large share of your rent can be deemed deductible. And then lastly, that even more aggressive approach where you get a legal opinion that says that this tax doesn't apply to you, with the hopes that the IRS concurs either now or in the future.
Correct. Exactly.
Okay.
You got it exactly right. You now can work at my company and do tax returns.
I'll leave that to you, but that sounds like a lot of fun.
There are other strategies that are also used or recommended by some firms, including like creating a management company to handle your advertising and other administrative tasks and things like that. Now, those types of strategies are highly scrutinized by the IRS and can be implemented and help with the effective tax rate for companies, but they have to be separate owners in an actual separate business, arm's length, and they can't just be put there for the form of it and get the deduction. There has to be a real viability to that because this is a very highly audited area and the IRS has already cracked down on this. So that's another strategy that can be used if there's an actual management type of company, but you have to be very careful.
Makes sense. I know in the current environment, people are looking for all opportunities to reduce their tax burden, whether they're in the cannabis industry or not. I know in the big, beautiful bill, there was a few Easter eggs in there that were beneficial to businesses. Are any of those extending to the cannabis industry without necessarily increasing audit exposure for the licensed operators themselves?
I would say yes. So the main, well, a lot of things actually. The corporate tax rate is set for 21%, which is great. It's also a highly recommended entity tax form for cannabis operators. So most of the cannabis companies that are created are formed as LLCs, single member LLCs owned by the licensee. And then, you really have to make a decision on how you want to be classified for IRS purposes. And there's, 4 different types of entity forms. You have your C corporation, you have an S corporation, you have a partnership, or you can remain a single member LLC and be a disregarded entity and be taxed by whomever owns you. If you're an individual, it just goes up to your individual 1040 and you're reported on Schedule C.
Right.
Of those potential forms, a C corp is my general go-to, although there are exceptions to that. And that's for several reasons. And one of them has to do with the One Big Beautiful Bill Act. But reasons outside of the One Big Beautiful Bill Act is that as a corporation, the company is taxed at the corporate level and there's no flow through to the owners, which makes a little bit easier accounting because you don't have to make distributions to each owner to pay for their taxes, and everyone might have different effective tax rates depending on if they're married or what other income they has, and it gets a little confusing. And also, if the company is audited, if it's a flow-through entity, then the individuals are usually audited too, so it creates a lot of problems. A C corporation is great because it's just taxed at the C corporate level. With the One Big Beautiful Bill Act, you have a 21% tax rate for C corporations, even though there's double taxation. But the biggest bonus is Section 1202, which is the Qualified Small Business Act, Qualified Small Business Stock. And if a company is formed properly as a C corporation and they keep the company for at least 3 years, there's a phase in of what that company will be had excluded from tax, the owners, if they sell. And in the cannabis space, we see there's a lot of compression, there's a lot of distressed companies, there's a lot of mergers and acquisitions. So even as they're setting up as a C corporation, if you're set up from the onset, you could potentially avail yourself of this Section 1202 treatment, which the One Big Beautiful Bill Act made even better. And it is a beautiful thing for companies if they're eventually going to sell or consider selling, because they could exclude, the individuals could exclude capital gains, a certain extent of their capital gains, a large amount from their income on a sale or disposition.
Yeah, under that QSBS, it's something like up to $50 or $75 million in gain that can be excluded. It's a pretty big number, right?
It's a very big number. Yes, it's a huge number, and they expanded it. And they also phased it in. It used to be you had to hold on to the company for 5 years. Now it's 3 years. You get 50% excluded, 4 years 75%, and 5 years or more 100%.
Yeah,
so it's a great decision.
Great to know that also extends to the cannabis industry. So that's terrific.
Yes.
We just have a few minutes left, and I know you've got probably a stack of tax returns you also need to get to. So as as folks are thinking about in the next week or so, hey, I'm going to do an extension. I'm still looking at how to structure things, especially as you mentioned, folks that this may be the first year they're filing, thinking about some of the operators in new markets like New York and Minnesota. What's the best advice that you can give people as they're thinking about this year's tax return for 2025 that they're filing now? And is there anything they want to start doing right now to be better prepared for the 2026 taxes?
There's a couple of points I want to make, and there's one other tidbit that might be very useful for companies. But as they're preparing their 25 tax return, you might consider extending the return so that you can watch legislation over the next 6 months and see what happens. Meticulous record keeping that is contemporaneous with what is going on is extremely important. So whether you're a dispensary, a cultivator, a processor, or in the space in any capacity, it's very important that you have meticulous record keeping. You have to have a good chart of accounts. You have to be able to track these allocations. If you're going to have a 280E opinion done for you, make sure you have a reputable law firm, to do it, and you have everything in order to take care of it. And one thing that's really useful to understand is as you look through different states, some states follow 280E, but a lot of the states that have legalized cannabis for medical or recreational purposes have actually decoupled from 280E. So for example, in New York, they've decoupled from 280E, meaning that for a cannabis company, although for federal purposes, you have to follow 280E, you can't deduct everything. But for New York State purposes and also New York City, you get to deduct everything as if it's a regular company. That also means for many states, including New York, that if you're treated as a regular company and they decouple from 280E, there's tax credits because every single state wants companies to do business in their state. They also want you to do innovation and they want you to hire people. So for example, and this is just one, but it's in many states, they have, in New York State, there's something called the investment tax credit. Now, if you are, in general, the investment tax credit applies to manufacturers that put their machinery and they manufacture in New York State. Now, a cultivator and a processor in New York State that buys machinery, even if they're in the cannabis industry, could avail themselves of this. So if I'm a cultivator and I buy a $1 million extraction machine, there's a 5% credit on that you can get in New York State. So I would say that companies should not forget about state incentives and things like that they can also take advantage of, because these are never, I say never, but most often not looked at. And there could be little tidbits. And if you're in the space, you really have to consider any cost saving efficiencies that you can have and any tax saving efficiencies that you can render yourselves.
Makes sense. And I guess the one disclosure that we always have to say is, even if you're extending your taxes, you still have to estimate your payment and pay now, right?
Excellent point, Tony. Yes. So it's an extension to file your return, but it's not an extension to pay. And as you enter 26, we are also going to enter into estimated payments that are due for 26. So we want to make sure that you are, calculating where you are year to date for 26 and your projected income, revenue, and expenses for 26, and paying in also your 26 estimated payments, if not, whatever, depending on whatever position that you took or you're taking for your tax return.
Well, Jill, I think you demonstrate why it is so important to have great professionals on your side, especially when you're looking at these complicated issues of tax and in an environment where it's potentially a number of changes coming in the year ahead, hopefully. I know a lot of operators are hoping for those changes to be clarified. Yes. We really appreciate you taking time out of your super busy schedule to join us, and happy tax day is just around the corner. And I'll pass it back.
Yes, happy tax day. Thank you so much, Tony. And thank you for all that you do in your industry. It's imperative in the banking industry for cannabis companies. So thank you so much.
Thanks, Jill. Jay, I'll pass it back to you.